The next AI Shockwave is not just another product launch. Information technology is not just another chatbot upgrade. Information technology is the AI IPO wave. And when the biggest frontier AI companies enter the public markets, the game changes. Private market hype becomes public market pressure. Growth expectations become quarterly scrutiny. Infrastructure spending becomes investor risk. And enterprise customers become the monetization engine. This is the industrialization of AI. Once these companies go public, the pressure will not be to slow down. The pressure will be to grow. Grow revenue, grow adoption, grow enterprise contracts, grow agent usage, grow API consumption, grow premium tiers, grow cloud commitments, grow infrastructure utilization, and prove a path to profit. That means one thing for corporate buyers. AI vendors will push harder to turn AI from a tool into a dependency, because dependency creates pricing power, and pricing power creates public market value. Here is the silent agenda, not conspiracy, incentive. Turn AI into the operating layer of work. Embed information technology into procurement. Legal, finance, HR, customer support, cybersecurity, engineering, marketing, sales, operations. Then, monetize the dependency. Subscriptions, usage fees, premium models, agent charges, API calls, data workflows, enterprise minimums, integration lock-in. That is where this is headed. If executives think they are just buying software, they are already behind. They are renting capability from a dependency chain they may not control. AI does not run on magic. Information technology runs on chips, cloud, data centers, power, water, cooling, memory, land, grid capacity, and capital. The public story will be productivity. The real story will be infrastructure. As AI companies chase public market growth, they will need more compute, more data centers, more power, and more enterprise usage to justify the build-out. That cost will not stay hidden. Information technology will move into vendor pricing. Cloud bills, utility pressure, enterprise budgets, community disputes, and board-level risk. The AI economy may look digital, but the bill is physical. Wall Street will love the story at first. Frontier AI agents, cloud growth, chips, data centers, cybersecurity, enterprise automation, national competitiveness, massive productivity. Information technology is a powerful narrative, but Wall Street will eventually ask the brutal question: can these companies actually make money after compute, cloud, chips, infrastructure, energy, talent, security, litigation, and regulation? If the answer is yes, the AI public market supercycle accelerates. If the answer is no, the market will punish the entire AI stack, not just one company, the stack. Chips, cloud, data centers, software, power, private valuations, AI narratives, everything. Main Street will feel this too. Not through IPO filings, through reality, job redesign, entry-level career pressure, customer service automation, white-collar disruption, higher utility strain, data center land fights, water concerns, grid upgrades, local tax battles, and communities asking why they should absorb the burden while distant shareholders capture the upside. That is the uncomfortable truth. AI wealth may concentrate. AI costs may distribute. Wall Street may celebrate the build-out. Main Street may pay for pieces of information technology. Now, here is where corporate buyers need to wake up. Most enterprise AI vendors do not fully control the AI stack. They sit on top of upstream model providers, cloud platforms, chips, data centers, and infrastructure they do not own. When upstream costs rise, buyers pay. When model terms change, buyers adjust. When usage rules tighten, buyers absorb information technology. When availability changes, buyers scramble. When indemnity is limited upstream, liability gets pushed downstream. That is the middleman trap. And after the IPO wave, that trap gets worse. Public companies will need to monetize harder. Enterprise buyers will carry more of the cost. Boards should ask these questions now. What AI vendors do we depend on? Which vendors rely on upstream models they do not control? What happens if pricing changes? What happens if terms change? What happens if the model changes? What happens if the vendor goes public and shifts its commercial strategy? What happens if our usage grows faster than budget? What happens if AI becomes embedded in critical workflows? What is the fallback plan? And who owns the risk when the AI dependency chain breaks? If management cannot answer, the enterprise is not ready. This is where the AIPOC.ai lens becomes direct. Red, identify exposure. Map every AI vendor, every AI feature, every model dependency, every agentic workflow, every data flow, every pricing model, and every infrastructure dependency. Yellow, prove before scale. Do not scale because the vendor is famous. Do not scale because the market is excited. Do not scale because the tool is popular. Validate ROI. Validate security. Validate privacy. Validate legal risk. Validate cost. Validate fallback plans. Green, governed readiness. Deploy only when the enterprise has clear ownership, cost visibility, vendor accountability, data protection, human oversight, usage controls, and board reporting. That is 2030 readiness. Anything less is exposure. The AI IPO wave will not make AI calmer. Information technology will make AI more commercial, more aggressive, more embedded, more expensive, more infrastructure dependent, and more difficult to unwind. The public markets will demand monetization. AI companies will pursue dependency. Vendors will pass costs downstream. Enterprises will be pressured to adopt faster. Boards will be expected to govern smarter. The blunt truth is this: the future AI economy will not be built around your comfort. Information technology will be built around control, pricing power, infrastructure, and dependency. Executives and boards need to get ahead of this now. Inventory information technology. Classify information technology. Contract information technology. Control information technology. Measure information technology. Report information technology. Or prepare to explain why your company became dependent on an AI economy information technology never properly governed.